This is our Forex blog for April 8th, 2013. And one of the things you can do with our software is make all of the charts the same color. And then when you push in this button right here, it lets you practice trade. And so when you scroll one chart back or use the left or right arrow to go one bar at a time, it will scroll all of them back at the same time. And this is one of the better ways of practicing and getting the hang of all of our tools without risking your hard-earned money. So when you do start to trade, you'll start to spot patterns and be able to take those trades with high probability. For the last 7 or 8 years, we've focused on using a currency meter, which looks just like the histogram on the bottom. We would show each currency, the dollar, yen in this case, and show the real-time statistical strength or weakness, comparing all the currencies together, all the dollar pairs versus each other, all the yen pairs versus each other. Underneath that we have the daily, weekly, monthly trend. This simplifies trading, because when you see the real-time trend up, the daily, weekly, and monthly trends up, the trend tends to continue. And you can see here in the Euro index, when it's underneath the hourly, it's more likely to go down. When the hourly is the gray line, the green line is the 15-minute moving average. Above both of those, it tends to trend up. When all the longer time frame trends are up, and you see this move up right here being of such a huge statistical nature, that's a trend that's likely to continue, and you can see the euro continues up. So basically, how to use this tool is similar to how we've traded for 7 or 8 years with the currency meters. You find one that's strong and you buy it versus the weak. If the top currency is the weak one, and then you would sell it versus the strong. And so it's that simple. And when one currency is underneath its hourly and the other one's above its hourly, you want to buy the one above the hourly versus the one below. And there's 2 entries that we use, but let's just look at the euro versus the pound here earlier today. And I'm going to get rid of this range chart. We'll just keep it simple. It doesn't matter what time frame. Using this concept, you can use 1-minute charts, 2-minute, 3, 4, 5, up to maybe a 15-minute. You can use tick charts or range charts. So we know the euro's strong today and the pound's weak, and we knew that going all the way back to a little bit before 3 when the euro broke out. The pound was already underneath its hourly. It found resistance here at 3 as well as 3:30, and it was very likely to go down. So it's that simple. 3 o'clock, you start watching this currency. The euro pound's underneath the hourly, so it's still combining them together, it's more likely to go down. But you wouldn't sell this here because we're looking for the euro to go up and the pound to go down. So when it breaks out from this level, you get into that trade. There's really 2 methods that we use to get in. One, as early as possible into the move, and secondly, a pullback. Every currency has its own kind of volatility. So typically, I would like a 15 to 25 pip pullback. And so you can see from this level 04 down to 86, it's almost 20 pips. That's a pullback. As soon as it breaks that trend line, you go in, you put your stop underneath the low, and it's that simple. And you can see the first trade worked, and the second trade worked too. You put your stop a few pips underneath the swing low. Anytime it goes up and then comes back down, when I'm expecting the possibility of the trade not working, typically our trades tend to go our way immediately. So if it goes up, down, starts to go back up, you want to move your stop to break even as soon as possible. You also want to be aware of where the double top is. That's oftentimes the end of the move. Our containment bands tend to contain price, so I would have probably exited half the trade there and yanked my stop up underneath the previous bar's low. It looks like I would have got stopped out there a little bit earlier than would have been ideal, but regardless, that's how I personally trade. Everyone has to find an exit method that makes them feel comfortable. I also am a big believer of fib targets. So let's take a look at all the currencies together, and we'll scroll through these. The Australian, the weekly and monthly trend is down, and this is going up to the point of control. This is where the Australian, all the Australian pairs had their average price for Friday. It's a major resistance area. You can also see it fell 29 pips Friday from Thursday's point of control. So obviously that's a pretty decent down move. It's very likely to be resistance here. And having each currency as a chart allows you to see double tops, double bottoms, lets you see if it's above its hourly, lets you see if it's above its previous day's high. But you also know the longer term trend, and when it hits a major resistance area and it breaks that trend line, right here around 4, you want to sell the Australian. Now it's not, because it's been trending up for a day and a half, it's not likely to fall the rest of the day, but it could because the longer term trend's down. And basically you want to sell the Australian versus a currency that's going up. You can see that the Swiss found support the previous day's low and it's been going sideways. Anytime you get a 2-hour range, 2-hour plus range rectangle pattern like this is a pretty high probability. The euro is even better because it's been above its hourly for an hour and it just broke out on that bar above the previous day's high. So a no-brainer type trade would be buy the euro versus the Australian. And I'm not saying that this is the best of all the pairs. Obviously the yen is the weakest of all of them, and so the best trade here at 4 would be to buy the euro yen. But we're just going to show how to use the trend line here because, you know, obviously anybody can see that the yen's the weakest, and that would, you know, make the most sense to trade this one. It's underneath its previous day's low. And we'll look at that one in a second. At 4 o'clock a.m. Eastern Time, we're looking to buy the Euro Australian. And we're watching this a little bit before 4. Here's 4 o'clock, and it's underneath the hourly right here. You can also see kind of a trend line right here. So you would be long right when it goes above this bar or the trend line, maybe by a pip at 25.18. You also want to have your stop underneath the low, very, very tight stop. You realize that the hourly here might act as resistance. So I'd move my stop up here and automatically lock in some profit, and I'd also draw my fib from here to here and probably exit half my trade here at 46. If it goes up to 55, I'm going to exit the second half. If it shoots through the first fib target, I'm going to hold on, and usually what I do myself is get out of the whole trade here at 55. So I'm going to get out of half my trade here at 46 because that's usually what happens, or the majority of the time. It kind of tags the 1.382 Fibonacci profit target. And then you will use either a trailing stop or what I oftentimes just kind of eyeball it. The second exit would be when it falls usually a few pips below the previous bar's low. And so I'd be out of the second one. So this trade I would be in here at let's say 20, out at half at 46, out of the other half for maybe around 38. So you can see by having the currency indexes and seeing a major resistance area, seeing the longer term trend down and the longer term trend of the euro up, seeing the euro break out here as this one breaks the trend line, it's a no-brainer. So let's look at the even more high probability. The euro is trending up, breaks out right here. The yen is already weak. 4 o'clock. The euro yen is more likely to make you more pips than that. So you can kind of watch this coming up to, actually this one started going up beforehand. So in some cases I might be, because it's already near the upper containment band, I rescind what I just said. It's a little bit riskier trade. If it was just going sideways right here, if this was 4 o'clock right here, it would be an amazing trade. I'm going to trade a little bit smaller lot size because the upper containment bands tend to contain price. Alright, so you would get in that trade right here, put your stop underneath the bar's low. Oftentimes riskier trades like this you get stopped out with the first trade, and then the second one tends to be the one to go. So this is kind of working its way up. I'm going to move my stop real close to break even. Alright, it's kind of inching its way up. And I usually use a time stop. This trade, it's almost been an hour, 45 minutes. I'm going to try to exit half the trade with a few measly pips and move my stop to break even. And so, you know, I would have made it just maybe 3 to 4 pips on the first half and break even on the second. Notice the pullback. It's on the perfect oscillator. It's underneath the -80 level. This is kind of where I'm looking to get into a pullback. And on a 5-minute chart, you probably can't see the perfect entry. So we're going to drop back to a range chart, or you can use a tick chart. Actually, let's show both of them. We'll just bring up euro yen. We'll look at 50 ticks per bar. This is basically 50 price changes per bar. When that happens, there's a new bar. Alright, so let's go back to this 4 o'clock pattern right here. With this, notice, you know, you can kind of get into a trade and have a very, very tight stop. You can also see, when the previous swing didn't bust out through the high, you get out of the trade there with maybe 8 to 12 pips. You can also, scalp trades that are up near statistical likely reversal areas. So you're in here, you're out, you're in here, you're out. Maybe you made 15 on the second trade. It pulled back and then kind of went up and down, up and down. Usually that's a continuation pattern when it's in a currency that's strong versus the weakest. So we would be long again right here where they're stop underneath the low. And typically if it doesn't go my way immediately, you can see it kind of went up, down again. I'm moving my stop up real fast. And when this thing takes off, any sign of it stalling, I'm out. So I would have been in this trade right here at 63 and out of the whole thing somewhere around 79. But you can see a 50-tick chart makes it a lot easier than 5-minute chart. And another thing you can do is use our range charts. Here's a 5 pips per bar chart. Each of these bars is 5 pips. And you can see also it helps you get in and out. And a lot of times when you see up, down bars, it's a reversal at the high. At the low, up, down is a continuation pattern. At the highs, it's the trade's likely to be over, so you want to get out as soon as it goes below that level. So basically, with this, you would have bought this breakout here with your stop. You move it up. It failed at the high. Notice up, down, so you're probably out somewhere in the middle here. Pull back again. You go long right here with your stop underneath here. It goes up, comes back down. At this point, I'm a little nervous. I'm moving my stop a few pips underneath break even. It goes up, down. I'm out right here. Small profit. Pulls back. I probably would have got long somewhere around here. I'm a little nervous right here. I might have got this at break even and had to go in again. Anytime I do that, if I can make 8 to 12 pips, I'm going to. And you can see here is a big pullback because after 5 o'clock, the Euro's trend probably wasn't continuing, and neither was the at 5 o'clock, the yen's exploding up. Let's zoom these all out so that they line up again. You can see the euro pulled back, found support to 15. The hourly's right underneath it. It's hovering right at the previous day's high. The yen has been below the hourly all day. Let's take a look at some of the other trades we can do real quick. If you see a currency that is above the hourly, above the previous week's point of control, but you don't see that much strength in the daily, weekly, monthly trend on the bottom, if it breaks down, it's a pretty high probability short. Usually the previous day's low or the lower containment bands is a profit target. If it kind of just falls a little bit and can't hit those levels, you might want to just get out of your profit here. If it breaks down later, you can get back in again. You also have trend lines on any of these. Now, if the New Zealand didn't have such a strong longer-term trend, you would definitely want to sell a nice, beautiful trend line like this. As you can see earlier, trend line breaks, even when it's against the very strong trend, is a great scalping method. I mean, 10 pips a day doubles your account every 2 months. So if you can spot a trade like this at 330, 345, which currency is going the opposite or likely to go the opposite direction at that time? This one's likely to go down. We want to find one that's likely to go up. Well, we already showed the Australian going down. It was a higher probability trade than the New Zealand because its longer-term trend was down. But you still have this one near the upper bands and a trend line break right here. You could have also traded the Euro New Zealand long at that time. You can see at 4 o'clock. This one unfortunately is underneath the hourly, whereas the other one I think was above it. But 4 o'clock, you have this trade right here. Normally they work their way back up to the hourly. So your profit target's around 40. You're in this trade around 10. So it's a 30 pip profit. I would personally have put my stop a pip or two underneath this little swing low right here. Because it's underneath the hourly, because we're doing a counter trend trade back to the hourly, you don't want to risk more than 8 to 12 pips. And one last thing before I end today's class. The perfect oscillator, when it's underneath the minus 80 level or at or above the upper level, it's a very high probability place to look for trades. Notice this level here, it did go down a little bit more and then shot up. This nailed the high. When you see a pullback underneath the hourly, when this is at an extreme level here and here, not a bad place to go short in those cases. You know, you'd be short somewhere around here, somewhere around here. And these also make great profit targets. Notice the minus 80 level, end of the move. Minus 80 level, end of the move. And that's why I call it the perfect oscillator. Usually, I mean, you can see even the tiniest move during the dead time of the day went up 14 pips. This one went up, you know, 20-something pips, 20-something pips. Fell 30-something pips, fell, you know, 30 pips. The perfect oscillator, while nothing works 100% of the time, as you can clearly see, I pointed out first the one that didn't work. Obviously, if you bought here, you know, it did go up 10 pips before falling, but it didn't really pop 20, 30 pips like we'd hope. But you can see even the one that didn't work still went up 12 pips. So again, that's why I call it the perfect oscillator. So between the perfect oscillator and our indexes and the longer term daily, weekly, monthly, I only show the weekly, monthly on these to try to conserve chart space. But you can see on here daily, weekly, monthly trend. It's just very easy. You trade the ones above the hourly, especially when you see statistical strength. Put the FX trend intensity on the currency indexes, and you can load this. It's already set up for you. Hit load, go to chart examples, and you can see Forex currency indexes. And if you want to add it to your existing charts, all you got to do is uncheck this, clear current workspaces, and you can put it in any layer you want, and you're done. Watch these like a hawk and spot all kinds of, you know, amazing patterns: double tops, double bottoms, failures to break out. You know, you have this nice little trend line right here. It's kind of getting into a very tight range. 10 o'clock, the yen is at another good place to sell. It's also making new lows right here at 2 o'clock. 2 o'clock, the dollar's trending up, the euro's near its highs. It doesn't get any better than that to buy the euro versus the yen at 2 o'clock. So let's finish today's class or blog video with the euro yen at 2 o'clock. You know, it doesn't take a rocket scientist to use these tools and catch great trades. Here's 2 o'clock. It's breaking out to new highs. And notice here, 75 to 90. It goes up about 35, 40 pips right here. And again, when you have an uptrend, notice these minus 80 levels, you know, are very close to them. Buy here, 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 and you can see you made money, a little bit of money, lots of money, lots of money. So use our tools. There's a reason why we give our software away for free, because we believe it works. That's why we do our blog video every day. You can see it yourself. And, you know, once we turn traders profitable, and they tend to be very active traders, and that's our whole goal.